brave to take on writing a book, not for the faint-hearted, not for those without as much time as you have, as well as when you're trying to work on the side. What sparked the idea? Why sign up for such a Herculean task?
Well, I do enjoy writing. I've been covering tech stocks and internet stocks for 25 years. I did want to take a stab at stepping back and thinking about big lessons. And then I was a little bit inspired by a classic book, Peter Lynch's One Up on Wall Street, written in 1980. Just great fundamental advice for retail investors, even institutional investors, about how to tap into the market. And I thought I wanted to do something similar, except using today's household names like Amazon, Netflix, Facebook, and Google. I thought I could pull together those lessons. I enjoyed the process.
And let's talk about some of the fundamental advice, because a lot of it comes down to perhaps not looking at fundamentals in the way we used to, certainly with value stocks.
Well, I think that's true. If I step back, if there's one thing I try to get across to people, one thing only, it's remember the phrase DHQ, or the acronym DHQ, dislocated high quality companies. I think the best way you can invest in the market is try to mitigate valuation risks and mitigate fundamentals risks. And you do the first by looking for stocks when they've corrected 20 or 30%. The second, though, is the more important thing, and you try to find these high-quality assets that have facing large total addressable markets, excellent management teams, super strong consumer value propositions, and companies that are really good at product innovation. If you put that package together, those can be really good, sustainable investment longs. I guess that's another thing I'm trying to get across in this book. You don't need to trade to make really good money. With lots of caveats around there. You don't need to trade to make really good money investing in stocks if you invest rather than trade.
Yeah, but sort of buy and hold. And many didn't when it came to the likes of Apple and Amazon. If I could sort of be paid $1 for every story of someone who says that they sold out at the wrong time. How much perseverance, how much patience did investors need to ride out the promise of no jam today, but jam tomorrow? We're investing for the business, but longer term, you will get your profit.
You needed to have that. One of the things, I'm going to cut this both ways, Caroline. I look for management teams that are truly relentless. I love to see founder-led companies. They don't always succeed, of course. But if you look at the history of tech stocks, the biggest winners have almost always been founder-led, founder-run, obviously, but founder-led for multiple years. The biggest tech market cap names in the world have had founders involved for 2 decades. You get that kind of consistency. In investment parlance, there's this saying that past performance is no indicator of future performance. That's true. But when it comes to management teams, and especially product innovation, which is so critical in tech, actually, I think that good, successful product innovation is usually a harbinger of an ability of a company, of a management team, to do more than that. So you stick with that stock, that company, through the ups and the downs of the markets, and through company mishits, because I haven't seen really even the most successful companies avoid mishits from time to time.
Talk about some of the funny moments within the book, some of the particular anecdotes or experiences that you really had to share.
Well, I'll tell you about one of my worst stock calls. Wasn't funny for me at the time, but I had to sell on Google at the time of its IPO, brought on TV right after the first earnings, when the stock was gapping up, and I was referred to as having a 3-egg omelet on my face from one of the wiser tech columnists, strategists on the street, and he was right. But it was a great learning moment for me to kind of step back and think about, where's the real product innovation going on in the sector? Leave aside valuation. Valuation is super important, but to me, it's almost the last thing you should do. You should really check off the boxes, find a high quality asset, and then think about valuation. One of the mistakes I made early on was focusing on valuation first. Find a really good asset and then think about entry prices rather than go the other way.
Well, then bring it to the here and now, Mark, because it's very hard not to look at valuation first and foremost when we've had the run up in stocks that we have. And when you see the darlings of today, the Teslas suddenly take a nosedive to the tune of 11%. They all have their idiosyncratic reasonings around that. But what now of valuations? Is it now the good time to still be looking at growth names?
I think so, but you can always find dislocated stocks. So that was one of my lessons in the book. Even the best, highest quality assets get dislocated, will trade off 10, 20, 30% from time to time, sometimes because of company missteps, but sometimes just because the market rolls over. It happens. Even the mighty Amazon has had a 30% roll off. And when you see that in the highest quality assets, that's when you should buy or add to positions. So I look at companies today, the highest quality internet companies that I look at, which would I say are most dislocated today? 3 ideas come to mind. First is Amazon. It hasn't dramatically corrected, but the stock's flatlined for about 18 months now. I think that, and the future cash potential has grown. I think that's a great stock to buy if you're willing to look out 12 months or more. Second is Facebook, highly controversial. I think great business model, wonderful value proposition. That's the second one. And third, controversial, is Uber.
Yeah.
But I think that's the least, it's the least proven of these. It's still relatively new, but the total addressable markets are massive here, and it's one of the leaders in that market. Lots of great value proposition to consumers, drivers, merchants, et cetera.